There are a number of storm clouds in this economy, and it's very likely we will have a major recession or depression and a huge stock market crash. When you look at the way the market has kind of levitated recently and hasn't crashed or gone down further since like the October and November lows, you have to wonder why this is. People are still optimistic. They almost have this belief that the Federal Reserve is going to help levitate the stock market. They're not going to go further with the interest rates than they already have. But the truth is, a lot of bad news is not priced into this market. This Federal Reserve notices that inflation is really historically high, and they don't seem to care if the stock market goes down. They're raising the rates. And because people have been conditioned to rates being 0% for so long, they almost don't believe it. They're saying, "Well, they're just joking with me. They don't really mean it." And eventually, they're going to change their mind. And so people are resistant to have massive liquidations and sell-offs. But the truth is, as these rates stay very high, it's starting to have real consequences and pain in the real economy. You're seeing the layoffs, even in the tech sector, in the crypto world, like Coinbase and all these exchanges. They're laying off people. They're laying off people at Facebook and Amazon. Apple isn't doing so right now, but they're not hiring as many people as they were in the past. And the fact that these tech companies, which year after year they would always have massive increases in revenue, now it's starting to level off and go down. It's a sign that these rate hikes that the Federal Reserve is doing right now, it's having some real damage in the economy. And actually the worst is not yet priced in. We haven't really got to a point where there's significantly higher unemployment. First, the economy starts to slow down, and people are still a little optimistic because the unemployment rate is still really low right now. But every day you hear about layoffs. It's like the weirdest level of propaganda. Job market is great. Look at how low unemployment rate is. But meanwhile, you hear a headline about a massive number of people being laid off at Google or Netflix or stuff like that. So there's going to be some real damage. And the truth is, stocks are not historically cheap. I think the S&P is around like 18. It's priced at 18 times earnings, something like that. That's still pretty high. I mean, the truth is, when there's real fear, the market actually can go down quite low in terms of PE. It can go down to 10, or I think it has actually even gone down to 7, which would be a great buying opportunity. Be like, wow, this is cheap. I'm going to be buying like crazy because it could fall even more. But at that point, you're like, this is a pretty good deal. The truth is, if you think about it, I've noticed this recently. A lot of people, they're still pretty greedy out there. They're still thinking that things are just about to turn around. Crypto, it has gone up pretty dramatically. I think almost like what was it, like 55%? How much has crypto gone up recently?
It's a good 40% probably over a month.
You need to reach a point where there's no more buy the dip people, and that will end when it becomes more and more clear that the interest rate hikes are causing material harm to the economy, which is actually happening because it takes time for the interest rate hikes to really influence the whole part of the economy. Like, think of mortgages. People don't buy a mortgage every day, but it's a slow process of people getting these or long-term interest bonds for corporations. Corporations don't get those every day either. And as more and more companies and individuals are dealing with the higher rates, you start seeing that there's some pain involved, and that hasn't really been translated to the stock market quite yet. And it is kind of a funny thing how people are prone to be optimistic because with stocks and investments, because I guess people who do make investments tend to be optimistic, but it takes someone who kind of is looking long term and can see the problems that exist. Like, for instance, the famous short seller Michael Berry, he's telling people to sell, and people are saying, well, he's wrong, look at the market has risen a lot, a huge bear market rally recently. But the truth is, Michael Berry and a lot of individuals, including including me, are able to see through the noise and can see that, yeah, there will be some short-term clips where the market for now is going up, but it will be there will be significant opportunities to buy crypto and stocks and things of that sort, but that time is not yet here. In fact, even when the Federal Reserve starts to lower rates, that actually may not be the buying opportunity. A lot of people think, oh, as soon as the Federal Reserve is starting to lower rates, that is the all clear signal to buy. That won't be the buy signal either. After the Federal Reserve starts lowering rates, there actually will be so much damage in the economy that the stocks may actually go down even further. And it may take time for even the lower interest rates to actually have an impact on the economy and allow the stocks to rise. So a lot of people are thinking a little bit too simple. They're thinking Federal Reserve does this, boom, it will instantly create the buying opportunity. That isn't true, because when the Federal Reserve started raising rates, it didn't immediately crash. It takes time for these things to happen. People need to be more patient and forward-looking, because you're not going to instantly get the right signals about what is actually taking place. But we're seeing the impact of a slowing economy, and the sad thing is a lot of things are getting worse still. The inflation is not going down, and some of that is due to supply chain issues and also commodities and things of that sort. And the Federal Reserve is really not able to solve a lot of this, sadly. I mean, the truth of the matter is that why is there inflation? I mean, some inflation is caused by Congress. When you spend every dime you take in tax revenue, you're borrowing some with bonds, and then that's not enough. You just print the rest, and that's what the Congress has been doing for a long time. Now, I'm hoping that right now, Federal Reserve, the Congress is not going to do that anymore. It's hope that they're able to say, you know what, we're not going to be printing an unlimited amount of money and spending an unlimited amount of money and just allowing the Federal Reserve to print it in order to make things work, because that can't work for the long run. And if something can't work forever, at some point it will break. We just don't know when that is. And that's also true for the stock market. It's it kind of lags a lot of these things. Because even though the economy looks weak day by day, you see the headlines, sometimes the market is not quite responding. Maybe some people think the market is actually looking way into the future and saying, well, it's going to be okay. But once it becomes clear that we're headed towards a prolonged downturn, maybe worse than 2008, maybe similar to the Great Depression, then it's going to be pretty clear that the market is going into a bad place. But the sad thing is, if you think about it, at that point in time, if we were to be entering a new Great Depression, I'm not so sure that people would care that much about the stock market anymore, because you probably will have cast out all your stocks in order to live day to day. So that might not be that great either. Anyway, I'm glad to provide this optimistic view, and click the like button, subscribe, and I'll see you in the next video.
When was the last time that you saw FOMO like this, where the market is going just vertical? And then if you did that, did you actually make money if you bought and held? I don't think you did, because I think
2009.
I think the last time we saw anything similar was around 2021, where you had exponential amount of short covering, where you had this retail crowd, the meme stock people, were just obliterating the hedge funds that were shorting, and you're kind of seeing similarity now. But I think, we're kind of seeing a little bit of a resistance at the 4,200 area. So I think it'd be good to, I'm personally going to be waiting for much better deals. Maybe 3,500 on the S&P would be pretty good, maybe even lower.
Oh yeah, that would be great at 3,000 or 2,800, something like that.